We welcome our viewers all over the world. In this video, we examine how greed and avarice within Nigeria's banking sector have led to the abandonment of the poor. The learning objectives are on your screen. We will understand how access to small loans can help reduce poverty by enabling ordinary Nigerians to start micro businesses such as akara, roasted corn, kuli, and petty trading. We will examine the failure of Nigeria's banking sector to provide meaningful credit to low-income citizens and small entrepreneurs. We will analyze the difference between grants and loans and why government grants should not replace a functioning banking system. We will evaluate the role of microfinance and commercial banks in supporting or neglecting the economic needs of the poor. Finally, we will discuss why banking reform and accountability are necessary if Nigeria is serious about poverty reduction and grassroots development. Useful resources are on your screen. There is a question Nigeria must ask plainly. What exactly are the banks doing for the ordinary Nigerian? The poor are told to be hardworking. They are told to be creative. They are told to start small. They are told to stop waiting for government. I am talking about the woman who wants to start an akara business, the young man who wants to roast corn, the mother who can make kuli but needs a little capital to buy ingredients, packaging, charcoal, oil, beans, ground nut, or a small table by the roadside. For many of these Nigerians, the amount needed to begin is not millions of naira. It may not even be the equivalent of $100. In many cases, a tiny loan, carefully structured, properly monitored, and connected to real business activity, can be the difference between idleness and enterprise, between begging and trading, between poverty and dignity. Yet the banking system in Nigeria is largely absent from this battle. This is not a minor failure. It is a national failure. A country cannot claim to be serious about poverty reduction when the institutions licensed to mobilize deposits, handle money, and extend credit do not meaningfully serve the poor. Banks are not decorative buildings. They are not supposed to exist only to collect charges, print debit cards, hold salaries, finance the already wealthy, and report profits. A banking system should help money move from where it is idle to where it can create activity, employment, production, and survival. In Nigeria, that bridge is broken. They are told that akara, roasted corn, kuli, petty trading, tailoring, hairdressing, food processing, and small retail can become the foundation of self-reliance. But when these same people need the smallest amount of capital to begin, the banks are nowhere to be found. What kind of banking system cannot confidently lend the equivalent of less than $100 to a serious applicant? What kind of financial sector cannot build a credible product around the smallest businesses in the country? What kind of banking culture sees the poor only as depositors and fee-paying customers, but not as people worthy of productive credit? This is where the statement by Nigeria's First Lady, Remi Tinubu, becomes important. She reportedly said that her office has been providing grants, not loans, to support small-scale ventures such as akara, roasted corn, and kuli businesses. The statement was meant to encourage self-reliance, and there is value in encouraging small enterprise. But it also exposes a serious problem. If the office of the First Lady has to step in with grants for businesses that require only little capital, then the banking sector has failed in one of its most basic responsibilities. Grants may help some people. Grants may provide temporary relief. Grants may give hope to selected beneficiaries. But grants are not a banking system. Grants cannot replace a functioning credit market. Grants cannot reach every community, every ward, every local government, every woman, every youth, every roadside trader, every food seller, every apprentice, every small producer, every person trying to move from poverty to productivity. A grant is charity or public intervention. A loan, properly designed, is economic infrastructure. That distinction matters. When banks refuse to lend small amounts to ordinary Nigerians, they are not merely avoiding risk. They are pushing the responsibility for poverty reduction back to government, churches, mosques, NGOs, relatives abroad, political patrons, and random acts of goodwill. That is not development, that is abandonment. The excuse is always the same. The poor are risky. Small businesses are risky. Petty traders are risky. Informal businesses are risky. But this excuse is no longer acceptable. Risk is the business of banking. Banks are not paid to avoid all risk. They are licensed to understand risk, price risk, manage risk, and design systems around risk. If a bank can finance luxury consumption, political contractors, large corporate customers, and speculative activities, then it can design a disciplined microloan product for a woman selling akara. If a bank can spend heavily on advertising, sponsorships, apps, branches, executive pay, and branding, then it can build a 50,000 to 100,000 naira micro-enterprise loan product with proper identity verification, group accountability, repayment tracking, community references, mobile payment records, and business follow-up. The problem is not impossibility. The problem is priority. Nigeria's banks have not made the poor a priority. And the microfinance sector, which was supposed to help fill this gap, is also showing serious weakness. Business Day reported that the Central Bank of Nigeria revoked the licenses of 46 microfinance banks over regulatory breaches. The reasons included failure to meet regulatory requirements, insufficient assets to meet liabilities, shutting down without approval, prolonged inactivity, failure to commence business after receiving a license, and failure to maintain minimum capital. That is a damning picture. Microfinance banks are supposed to serve low-income households, small businesses, and underserved communities. That is their reason for existence. If many of them are inactive, undercapitalized, badly governed, or unable to meet basic regulatory standards, then the poor are being failed twice. First by commercial banks, which often do not want to deal with them. Then by microfinance institutions, some of which are too weak, too poorly run, or too unreliable to carry out the mission assigned to them. The result is predictable. Poverty continues, informal lenders exploit people, small businesses remain trapped, and millions of Nigerians are told to start small without being given the basic financial tools to start it all. And to make matters worse, after all is said and done, the blame is conveniently shifted to the president of the country. That is nothing more than the lazy excuse of lazy individuals who refuse to do the work required of them. This is not how a serious country builds prosperity. In a serious financial system, a woman who can fry akara should be seen as an economic unit. Her business may be small, but it is real. She buys beans, she buys oil, she buys pepper, she pays for grinding, she uses transport, she may employ a helper. She feeds school children, workers, drivers, and neighbors. If she grows, she can buy more, sell more, hire more, and support her family. That is an economy. The same is true of roasted corn. The same is true of kuli. The same is true of puff, zobo, tailoring, laundry, phone repairs, food delivery, local farming, small retail, and hundreds of everyday businesses that hold Nigerian communities together. The banks may look down on these businesses because they are small, but poverty is reduced through millions of small increases in income. Development is not only about skyscrapers and big factories. Development is also about the petty trader who doubles her working capital, the young man who buys tools, the food seller who moves from one tray to a stall, and the apprentice who becomes self-employed. A country with mass poverty cannot afford a banking system that only understands big customers. Nigeria needs banks that can lend small, track repayment, recycle capital, and build credit histories for the poor, not as charity, not as public relations, not as one-off empowerment ceremonies, as a serious business model. The technology already exists. BVN exists. NIN exists. Mobile phones exist. Bank verification exists. Agent banking exists. Digital wallets exist. Transaction histories exist. Community associations exist. Cooperatives exist. Market unions exist. Religious and local networks exist. The tools for responsible micro-lending are not missing. What is missing is will. And because the banks are not doing the work, the federal government is being forced into spaces that banks should naturally occupy. When government offices start giving grants for micro businesses, it is not only a sign of compassion, it is also evidence that the financial sector is not reaching the base of the economy. That should embarrass the banks. It means that institutions created to move capital through society are standing aside while government offices step in to fund the smallest forms of enterprise. It should be a clear signal that these banks are not working to reduce poverty. They are working only to enrich their management. If that is the case, their licenses should be reviewed, pulled where necessary, and reallocated to banks willing to do the job. This would send a strong message that government cannot tolerate cronyism, institutional laziness, or any effort to subvert the will and welfare of the people. The ordinary Nigerian does not need endless speeches about financial inclusion. The ordinary Nigerian needs access to small, fair, understandable credit. Credit that does not require impossible collateral. Credit that does not bury the borrower in predatory interest. Credit that is tied to business activity. Credit that helps a person begin, survive, and grow. This is the moral and economic indictment. Nigerian banks want the deposits of the masses, but too often they do not want the enterprise of the masses. They want account openings, transaction charges, card fees, transfer fees, and deposits from ordinary people. But when those same ordinary people need productive credit, the door closes. That is not partnership. That is extraction. A banking system that extracts from the poor but does not invest in their productivity is not helping to reduce poverty. It is helping to preserve it. This is why Nigeria must begin to judge banks differently, not only by profit, not only by branch networks, not only by digital apps, not only by shareholder returns. The country should ask harder questions. How many micro-business loans did each bank issue this year? What is the average loan size? How many loans went to women? How many went to youth? How many went to first-time borrowers? How many went to rural areas? How many helped people move from informal survival to stable enterprise? How many borrowers returned for a second loan because the first one helped them grow? These are the questions that matter in a country where poverty is widespread. An account without opportunity is not inclusion. A debit card without productive credit is not empowerment. A banking app without access to capital is not development. The poor do not need pity from bankers. They need products that work. They need small loans that are fair, accessible, and tied to real livelihoods. They need a system that recognizes that a business does not have to be large before it deserves financing. Akara is business. Roasted corn is business. Kuli is business. Tailoring is business. Small farming is business. Street food is business. Petty trading is business. And if Nigerian banks cannot see that, then they are not merely failing poor people, they are failing Nigeria. Because poverty will not be reduced from the top alone. It will be reduced when millions of ordinary Nigerians can access the little capital they need to work, produce, sell, repay, and grow. That is what banks should be doing. And until they do it, no one should pretend that they are serious partners in Nigeria's fight against poverty. The learning objectives have been met. If you found this presentation informative and educational, please give this video a thumbs up and consider subscribing and sharing with family members, friends, and colleagues. Your support helps us create more informative and educational content. Until next time, stay strong, stay hopeful. This has been a presentation of Opomilero Media LLC.